The calendar has turned to February, and that means that it's time to look at what my favorite stocks are right now in the market. Each quarter, I buy stocks for the asymmetric investing portfolio. And in this video, I want to give investors an idea of what kind of companies I'm looking at today. This is the top stocks that I see in the market today and where I'm seeing opportunities. And these kind of stocks would be at the top of my list for where to allocate money today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. Let's start with one that I have been adding for quite a while, and that is Spotify. Spotify has not released earnings for the fourth quarter of 2023, but we do have an indication of what direction the company is heading. You can see from third quarter results that subscriber growth is really strong, 26% on a total monthly active user basis year over year. Premium was up 16%. Their ad business, this is where I would like to see even more growth in 2024, up 16%. And this is starting to flow to the bottom line with positive free cash flow of $216 million. But the good news for Spotify is all of this growth is happening as they're controlling their costs much better. This was the chart that they gave for operating expenses. And you can see that expenses are down 13% year over year. And most of those cuts are happening in sales and marketing and general and administrative. So overhead costs that Spotify had grown significantly during the pandemic when they were growing their revenue and user base, but those costs got kind of out of whack. Now, in the first quarter, they announced another 17% layoff. So these operating costs are going to come down even more in 2024. I think by the end of this year, this calendar year, Spotify could be generating $1 billion in free cash flow per quarter. That would be a phenomenal result for a company growing revenue and users this quickly. Now, Spotify is not a cheap stock by most metrics. The enterprise value to sales ratio is about 2.9. And remember, Spotify has relatively low margins because it has to license music from the record labels. So its gross margins are only going to be in that 30% range. That's why it's not going to get a price to sales multiple in the 10 range that you might see from a lot of software companies. But price to free cash flow on a forward-looking basis, so what analysts are expecting for next year, is about 40. And I think we could see an acceleration in that free cash flow. There's just a ton of momentum behind Spotify. And I think the company is clearly winning in the audio space. They're taking market share from the likes of Amazon and Apple Music. There's not a lot of companies that can say that they're taking market share from those companies. And this is the one horizontal services company in audio. So no matter what device you're listening on, Spotify is probably going to be on that device. That allows them to get into things like advertising, audiobooks, podcasts, and just grow the pie in the niche of owning your ears. And so I think that's going to be a really valuable position. Their financials are starting to improve already. And with operating costs coming down, revenue going up, I think we're going to see free cash flow and earnings increase significantly over the next year. The second stock is Alphabet. And one of the reasons that I like Alphabet right now is because the market doesn't. Shares were down after earnings. Then the market is nitpicking a lot of different parts of the earnings report from Alphabet. But if you take a step back and look at Alphabet's numbers, the company is growing its revenue in search. Profitability is improving in search and its search-related advertising business as well. YouTube continues to grow. And the cloud business is not only growing at a really rapid rate, it's now profitable, and that profitability is improving. So Alphabet is one of the biggest, most powerful companies in the world. And yet the enterprise value to sales ratio is just 5.6. Price to earnings multiple on a trailing basis is just 27. And this is a company that's still growing at a double-digit rate. So this isn't the cheapest stock in the world, but I do think that buying one of the industry leaders in a company that is extremely sticky, has no real competitors in the search market, and has a ton of potential in things like cloud, artificial intelligence, and even autonomous driving. I think this is still one of the best companies in the world to buy today, and I will happily take the discount that investors are giving over the last couple of days. The third stock is Zillow. And again, this is one that I was acquiring in 2023. And the reason is Zillow is becoming the go-to marketplace for all things housing. Of course, we know Zillow is the place you go to search, see what a home might be worth, use their Zestimate to do that. And that led to the business where they're basically an advertising platform for real estate agents. If you're going to look for a home, you might do that on Zillow. You ask for some information about that. They're going to actually connect you with an agent, not necessarily the homeowner directly. So that gives you an opportunity to become a platform company in housing. But you still have the MLS and agents who are actually controlling the market. They're the ones that are charging 6% to be a broker in a house. But the interesting thing that happened in 2023 was a lawsuit that said that that was collusion. The setup in the real estate industry between buyer's agents and seller's agents and the MLS was actually collusion. And the jury found that that was true. So I think we're going to start to see a breakdown between the fees that brokers from both a buyer's agent and seller's agents can charge. I think that's going to fall. And then customers are going to say, hey, if we have choices about what sort of fees we're paying, if I'm doing a lot of this work myself, looking for houses on Zillow, why am I paying you a huge fee when I can just go direct to the seller? That improves the position of Zillow as the marketplace where you're going to be listing homes, buying homes, finding mortgages. And now the really interesting thing over the last couple of years is their growth in the rental market. If they continue to grow in the rental market, that's going to be a much more steady market than the traditional real estate market they've been serving. And we've seen that volatility over the last couple of years, and it will increase their moat. I mean, who's going to be able to compete with them on a national or even global basis if Zillow is the place that you go if you're the buyer for homes or if you're looking for a place to rent? I think it's a phenomenal position to be long term. I don't know if that's going to mean that Zillow is going to generate a significant profit in 2024. That's probably questionable, but I'm thinking about this as a stock that I want to own for the next 10 years because I think Zillow is going to be a more and more powerful marketplace and platform in real estate, and this is a multi-trillion-dollar market. So huge upside for Zillow long term. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The fourth stock that I like here is Disney, and this again kind of goes against the grain for what the market is thinking right now. Shares of Disney are down because the company continues to lose money on streaming, and investors see the debt and challenges that they have in both streaming and then also the decline of the linear TV networks, and go like, why would I want to own this stock? But I think there's two reasons to own Disney long term. One is the streaming business is absolutely the future, and it's going to rely on the cash coming from the linear TV business. And Disney has been really strong in linear TV, with ESPN really being the core. They still have power in the market now. It might be a declining market, but you're seeing that there's cash flow coming out of that business, and they're reinvesting that in streaming. And the way that I think streaming is going to ultimately play out is there's probably going to be two major players in streaming and then a bunch of niche providers. So Netflix is clearly going to be one of those winners, but I think there's room for Disney, who has a unique bundle of intellectual property with Pixar, Star Wars, Marvel. This is really the place that you go if you have children. You bundle that with general entertainment that's now on Hulu and sports. The rumors that Disney is talking to the NFL about buying some of the NFL's media assets and then the NFL becoming an equity owner in ESPN is, I think, absolutely the right place for them to go, because if you can bundle those three kinds of assets together with the 100 million plus users you already have for Disney streaming, now you start to be the number 2 player compared to Netflix. And you maybe even have a bigger revenue base because you just have much more to offer, especially on the sports side where you're able to charge a little bit more of a premium. So I think that's going to be a rapidly improving business over the next 5 to 10 years. It may not feel that way today, but in 10 years, I want to be betting on Disney in streaming and not companies like Peacock or Max. On top of that, Disney has the parks and experiences, and this is a business that's generating almost $10 billion a year in operating income. So just phenomenally profitable. They're going to put another $60 billion into this business over the next 10 years. And I think this is where you start to have a business that has more revenue opportunities and more profit opportunities than even Netflix. And Netflix is absolutely a bigger streaming company, absolutely a phenomenal position, but it doesn't have these adjacent businesses like parks to deepen that relationship and increase revenue with your best customers. So that's why I like Disney. I think we'll see a number of asset sales, maybe some refinancing, but the big deals over the next couple of years are going to be in streaming and then expanding that parks business. Speaking of entertainment, the next stock on my list is MGM Resorts. MGM has about half of the Las Vegas Strip, owns a majority stake in 2 resorts in Macau, and now is also building a casino in Japan that will probably be ready right around 2030. And this has become just an absolute cash flow machine over the last few years. What a lot of people may not know is that Las Vegas actually recovered from the pandemic and is now hitting records. So after years and years of declines in gambling revenue, peaking in about 2005, we saw the recovery actually overshoot in Las Vegas. We have not seen that recovery overshoot yet in Macau. And I think that's where there's further upside for a company like MGM Resorts. So you're not investing billions of dollars a year in building out new casinos. You're just cash flowing the casinos that you already have. That's why this is such a strong cash flow business right now. And I think that cash flow will improve as Macau improves. Add in the fact that you get the upside in Japan starting maybe in 2030. That could be another market that is as profitable as maybe even Singapore or Macau was almost 20 years ago. So MGM has a market cap of just $15 billion right now. Price to free cash flow is just 10. They continue to buy back stock. I just love the position that MGM Resorts is in right now. And we're still coming off that COVID low. It may not feel like it in the US, but China is still in the process of reopening. They're only about a year out from their great reopening. And that has not been a smooth ride for Macau. So I think there's a lot of upside there. The next stock on my list is Celsius Holding. I don't need to spend a lot of time on this one because this is just a phenomenal growth company. You can see their revenue growth here has just been phenomenal over the last 5 years. And I think that's going to continue. Management has talked a lot about getting better placement on store shelves over the next year, working with a lot of different restaurant chains to get Celsius into those chains. And this is a very capital light business. This is something that I think is overlooked, is that they can grow without building new manufacturing plants because they're working with third-party bottlers to do that. The question right now is, what should investors be paying for the stock? And that's where I have a little bit of hesitation. The price to earnings multiple for Celsius right now is over 100. Enterprise value to sales is over 10. So that's a really expensive price for a beverage company and not a software company. But I think the growth is just simply too good to overlook. Over the last 5 years, a compound annual growth rate of 89%. That's just phenomenal. We haven't even started scratching the surface of international markets. And I think there's more markets in the US too that Celsius can expand into. So Celsius, a little bit higher risk because of the price that you're paying. We'll see how the quarterly numbers look here in the next couple of weeks. But I really like where the product is positioned and how the business is performing right now. So that's why it's among my top stocks right now. Number 7 is another high growth company that is On Holding. You might be familiar with the shoes that they make. They're moving into apparel, really big in running, and also has a presence in tennis. 3-year compound growth rate is 66%. And this company is just hitting on all cylinders right now. And I think it's still really undervalued in the sports and apparel market on a forward-looking basis. And this is based on analyst estimates and partially based on what management has guided themselves for the next 3 years. Price to earnings multiple is just 33. So it's growth rate in the 60% range and a price to earnings multiple of 33. That's the kind of value you want to get as an investor. Enterprise value to EBITDA, just 21 on a next 12-month basis. So I think you're getting a high growth company, you're getting a great brand, and you're getting it at a really good value compared to the growth that you're getting from On Holding. Now, the risk is, does this brand go out of style? And that could absolutely happen. But I think this is one company that has the kind of quality products, partnerships, and ultimately end market that is going to be growing and profitable at a very, very high gross margin, looking at gross margin in the 60% range for the foreseeable future. So that's why I love On Holding right now. And the final stock on the list, it might be a stock that you've never heard of. That is Portillo's. Portillo's is a restaurant company. They have about 90 locations in the US, but they're really heavily located in the Chicago area, what they call Chicagoland. And this is a very popular hot dog and beef sandwich restaurant. And it's a little bit like a cult. It reminds me of the early days of Chipotle. What Portillo's has done over the last few years since coming public is said, hey, we need to expand this footprint. They're looking to expand their footprint in the mid-teens range. They have 9 restaurants. They opened 6 restaurants in the fourth quarter of 2023, expecting to open another 9 restaurants in 2024. And each restaurant spits off about $2 million worth of cash. To put that into context, each Chipotle restaurant generates between $2 and $3 million in revenue. So Portillo's is doing more like $8 million in revenue per restaurant, and about $2 million in that is profit. One of their new restaurants actually was generating $17 million in revenue per year. That shows just how phenomenal this business is, how high demand is for their products. And they've struck this really good balance between having an in-store experience, a drive-through, and pickup products. You can even order some of their products and get like a big box and cook it yourself. So just a phenomenal growth company. Management is saying that they're expecting to grow in the mid-teens long term. I think that number could be even higher than that if they execute well on some of their store expansions. And the value isn't too bad right now. Price to earnings on a next 12-month basis is 37. Enterprise value to sales is under 2. Like I said, this is company still pouring a lot of their money back into expansion, so not focusing on profitability yet. That's exactly what you want to see from them. And if a company like this is able to execute on growing their footprint in the mid-teens range over the next 10 years, this is going to be a phenomenal stock, no question. Which one of these stocks do you like? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.